Yo, it's Hublo back with another video. As promised, I got the risk to ratio video for y'all, man. Rubbing my hands like Birdman because we're going to get right into it. So, what we're going to be covering in this video is going to be risk versus ratio. What is margin? What is equity? How to use risk to ratio. And we're going to give a golden nugget, which is the golden rules of risk management. And then we're just going to wrap everything up. So, first and foremost, thank you guys for being on this video. This is going to be part one of risk to ratio. If you're here, that means that you're serious about your trading journey and you're trying to figure out how you manage risk while in your trades, which is a very important key when you're trading. And thank you for being here. You're taking your trading journey very seriously. Remember, like, subscribe, hop in our Discord if you're not already in our Discord, and let's get to it. So, the definition. The definition of risk to ratio is profit per dollar at risk. So, you want to always evaluate this when you're trading because you always want to make sure you're risking less than what you're actually making. So the ratio evaluates an expected return against the risk taken. So that's just a plain definition of what risk to ratio is. Next, why does it matter? So it matters because it has to do with profitability despite taking losses. So even when you take losses, if you have a correct risk to ratio, you're always going to have a good percentage rate. It doesn't matter if you have a losing streak or whatever the case may be. If you have the right risk to ratio, it's always going to be in your favor. You're always going to have an above average uh, trading percentage because of your risk to ratio. So you always want to make sure it's in your favor. So a favorable risk to ratio safeguards overall gains even with losses. So just remember that and make sure you guys are taking notes, while this video is going on as well, or you can just kind of, replay the video. It's very important that you guys either take notes or replay this video multiple times. So, real life example. So, if I had to give you a real life example of what a 1 to 3 ratio looks like, which is a standard risk to ratio, if all your trades should be at least a 1 to 2 or a 1 to 3, or at the most a 1 to 5 or a 1 to 7. A 1 to 7 is like a swing, so if you're trying to swing, that's what you would normally do. You could catch a 1 to 5 intraday, pretty easily, and you catch a 1 to 3 fairly easily, and you can catch a 1 to 2 like this. A 1 to 1 means that you would be risking. Let's just say I was risking $300 to make $300, but at the end of the day, when you look at the grand scheme of your trading, you're risking what you would necessarily make. So if you take a couple losses, your percentage is going to go way down. So you always want to have a risk to ratio that's in your favor, which a 1 to 3 risk to ratio means you're risking, it says 1 unit to gain 3, but really it would mean in our sense $1 to get $3. So that's basically what you're saying when you say a 1 to 1. So I'm risking $1 to get $3. So that's all you're really doing when it comes to risk to ratio, and you want to make sure that you have a good risk to ratio when you're trading. What is margin? I've been getting this question a lot lately from my beginner traders, and it's a very great question because this is something that I didn't know about, and I had to research when I was a beginner trader. Like I was looking at my trades and I was looking on MetaTrader 4. I'm like, what is this margin thing? What is this equity thing? So I was just trying to figure out. Eventually I figured it out, but you know, I'm glad that you're here. To learn it specifically from somebody that's been through it, and knows what he's talking about. So the definition of that would be the trade opening amount. So your margin is the initial capital required to enter a trade. So that's the initial capital that you have in order to um, get into a position that you're currently either seeking or that you're about to get into. So how does it work? So leverage and control over bigger positions. So your margin allows you to control a larger position with less capital. So you can literally, if you have a good enough margin and you have a good enough leverage with a certain broker, you could have a $100 account and you could risk the whole $100 on that on a one trade. If the leverage allows you to do so. Um, and of course, your margin. Of course, like some brokers don't allow you to use your full margin when you're trading. So you got to always take that into account and make sure that you're choosing the right brokers and things of that nature. Which I also have a video on that. So if you look through the YouTube, you'll also see that I have a video on how to go about choosing the right broker as well. So you can be able to, if you want to do that, you can, use your full margin if you want to. So caution, win and lose amplifications. Margins can significantly increase both profits and losses. So the reason why a lot of either prop firms or brokers don't allow you to use your full margin is because you can go negative in your trading account. It doesn't mean that you would necessarily have to pay it back. The broker or whoever is in charge of that brokerage, they eat that charge. If you don't decide to trade on that account again, you could make a whole nother account. It's happened to me before. You can make a whole nother account, but the thing about it is that they put certain limitations and rules on leverage and margin because they don't want individuals to go negative in their trading accounts because then they have to more than likely eat that. There's very slim to none chance that if you're negative, let's say just $200 in your trading account, you wouldn't just probably just find another broker or just create another account with the same broker. You would more than likely you wouldn't just go put $400 in and then it eats up the 200. Kind of like if you go negative in your bank account, once you get paid, it eats up that charge and then you get the remainder of your money available. It's kind of like that. So you want to make sure that the brokers want to make sure they cover themselves. You want to make sure you cover yourself with risk to ratio and make sure you're paying attention to your margin and everything when you're trading. What is equity? This is another question that I've been getting a lot lately too, and it definitely plays a big factor in your trading journey. So let's get right into it. The definition: total trading account value. So the total value reflects all assets and liabilities combined. So your equity, it doesn't matter if you're in Euro USD, NZD USD. Let's just say you were in three positions at one time. Your equity would let you know how much available space you have to either add another position or if you wanted to now look at another a fourth pair to get into. So it allows you to see what your account balance is while you're in trades, so then you can see exactly what your equity is and see how much space do you really have to possibly get into another position, and or how much space do you have in your trading account as we speak with all the trades floating, whether that be in positive or in negative. So let's just give just an example real quick. If I had a $300 account, I was negative $100, my equity would be $200 now because I'm negative $100 in my account. Same thing going forward. If I ended up being $200 above in my $300 account, my equity would show $500, but my balance still would be at $300 because I have not yet closed that trade. So you have to make sure that you pay attention to that when you're looking at risk to ratio, looking at your margin, when you're looking at your equity. These are the things that are very important, and making sure you're paying attention to those things at all times when you're looking at your account. So why does it matter? It reflects real time account state. So the equity provides an accurate snapshot of financial health. So exactly what I was just previously explaining. Key tip. So what equity to prevent calls? So what that means is like it prevents you watching your equity. It prevents you from getting margin call by the broker. So if the broker feels like you don't have enough equity to stay in your trade, they'll automatically take you out, not only to save themselves, but to also save your account as well. And that's what their job is to do. It automatically has certain limitations set to where it will take you out of a trade. So if you don't want to be taken out of a trade to where you have little to almost nothing in your account at that point because you had no equity to stay in the current trades that you were in, make sure you pay attention to that. So regularly check your equity levels to prevent unexpected losses, because that loss would technically be unexpected because you would think that you're in a trade. And it's happened to me. I didn't have enough equity to stay in a trade, and I end up looking at the chart and the trade flew. I'm like, oh, I'm in the money. I go check it. I'm not in the money, y'all. I'm not in it. Why? Because my equity wasn't enough to keep me in the drawdown that I was in order for a price to then, elevate the way that it was looking to elevate. So, make sure you're definitely paying attention to that at all times while you're trading. How to use risk to ratio. Let's get right into it. So, setting up your trades. So, plan, entry, stop loss, take profit wisely. So, proper planning ensures discipline, trading, and risk management. So, you got to make sure that you're planning your trades, you're making sure that you're journaling, every day or at the end of the week when you're having these wins and losses. I know it's sometimes painful to journal those losses and stuff like that, but you have to make sure that you're journaling these things so you can be holding yourself accountable, because when it's trading, it's a mental game and it's you against you. I know sometimes it can hurt. It can feel like it's you against the markets. It can feel like you against the banks. It can feel like you against that retail trader, whatever the case may be. But at the end of the day, it's you against you. So you have to make sure that you plan and you assess your risk properly. So proper planning ensures discipline, trading, and risk management. So you always want to make sure you pay attention to that. Calculating risk versus reward. So just for example purposes, if my entry was at 1.2 thousand and my stop loss was at 1.950 and my take profit was at 1.2100, consider the trade entry at $50. We had a stop loss at $48, so that means I'm risking $2, and my take profit is 55. So I'm making $3. So in this scenario, this would technically be a 2.5. It'll be a 1 to 2.5 risk to ratio. And if we put our take profit at $56, that would make it a 1 to 3 ratio. So we will be risking $2 to make $6. So just to make it make sense numbers wise for you guys, so you guys can see how the risk to ratio works and how to calculate it with money. So just don't think about the 55, just think about 50 to 56, and you're risking, if you were to lose that trade, you would be your balance would be $48, and if you were to win that trade, your amount would be $56 at a 1 to 3 ratio, just for example purposes. Now, with the example that it has here, this will be technically a 1 to 2. If you want to get technical, a 1 to 2.5 ratio, which, it really doesn't, you could just say 1 to 2. It really doesn't, need all the technicals, but I know the numbers, so it just makes sense to me that way. But a practical tip. So discipline with TradingView. TradingView helps traders visualize risk to ratio effectively. So in TradingView, it definitely has risk to ratio for the buy and the sell side, and it allows you to go in the settings of that risk to ratio and put your account balance in there, how much you're willing to risk and how much you're trying to make. So then it can properly calculate your risk to ratio on the chart. So if you need help implementing that, if you need help visualizing that or anything like that, definitely drop a comment below and I can make a video on that for part 2. But definitely, that's definitely something that TradingView has to offer when it comes to risk to ratio. Golden rules of risk management. Let's get right into it. So position sizing. So risk 1 to 2% per trade. Now, I know a lot of the people you guys follow, I won't name drop a lot of the people you guys see. They're out here on podcasts and out here on their platform saying 1 to 2%. You'll never buy a Ferrari. You'll never be where I'm at, risking 1 to 2%. It's not true, y'all. At the end of the day, risk management, it takes time for you to get to the levels that they're at, to where they can have a 50K account and blow that and risk everything, is because they're at the place that they're at, because they had to use risk management at a certain point. And there is some merit to what they're saying. Sometimes if you don't risk bid, you won't get to those levels that they're at. But at the same time, as you as a beginner trader or intermediate trader, or even somewhat of an advanced trader, you have to use proper risk in order for you to have longevity in this space. So limiting risk protects your capital and ensures longevity. Diversification. So diversify capital to reduce risk. So I do this a lot when I'm trading multiple pairs. I'll lessen my lot size. So if I'm only good with risking $500 that day, I'll put let's just say a point 50, a point 50, a point 50 on each pair at about 20 pips, which is risking about $100 or so each trade. So I'll be risking $300 each trade. So as the trade goes in my favor, then I'll add the lots, to, equate to my ultimate risk eventually, to where I'll eventually reach that. I'll add a one lot, or I'll add a 1.50 to get to that $500 mark. And even if, let's just say, all those trades, end up failing, at the most, I would possibly have lost close to $600 to $700, give or take, if I were to have added those positions as market began to go in my direction. So it's all about diversifying your capital. And if you're going to do that and trade across different pairs, you got to make sure that you do it wisely and you do it in a way that is tolerable for your risk. So patience over perfection. Patience is one of the biggest things when it comes to trading, is being patient. Some of us are very impulsive in how we go about our lives, and sometimes it transcends into trading. And we have to learn that, trading is going to teach you a lot about yourself, and you have to be more patient when it comes to your setups and everything that you do when it comes to trading. Being an impulsive trader is only going to be to your detriment at the end of the day. So waiting for higher probability setups is where your bread and butter is going to come from. So focusing on opportunities with the best potential outcomes is a big part of risk to ratio, and making sure that you're executing your trades and you know, putting your trades in position to help you. And if you needed to cut them, or if you needed to do certain things, you're able to manage that within risk, if you need to, especially if you have a high probability setup. So making sure that you're analyzing your charts perfectly enough to where you're only taking high product probability trades. Every time you enter a trade, it's something that has a big potential. Nothing's ever guaranteed, but has a big potential of playing out. So that's definitely one thing you want to look for in the markets when you're analyzing and you're executing trades. So avoid revenge trading. This is a big one because we all struggle with this sometimes. Sometimes we, have a bad day, or have, but we still have equity in our account. We still got a little bit of money we could, try to like get in another position again. So try not to fall into that. There's some trades that are meant to be gotten back into, and sometimes it's just not worth it. Just for your mental, just for your account, just wait till your next session. Wait till the next day. It's gonna be okay. The market's gonna be there. Uh, if it's Friday, it's gonna be there next week. If it's Thursday, if it's Monday, it's gonna be there tomorrow. So make sure that you just take that time, digress, breathe. Sometimes I know it can be painful, but make sure that you're taking that time to understand when you're on the verge of possibly revenge trading. So don't let one bad trade define you. One loss doesn't determine your overall trading success, because it doesn't. So make sure that you're taking the time to diligently look over your trades, journal your trades, and make sure you're taking accountability for the losses that you do take, and also journaling those losses in detail so you can know what to do better next time. So we're gonna wrap it up. We're gonna wrap it up, and I just want to say thank you for watching this video, guys. If you this video definitely helped you understand a little bit more about risk to ratio, definitely like, subscribe to my channel for more content like this, and make sure you click that notification bell as well so you don't miss out on any new videos that might be coming out. If you haven't tapped into my Discord yet and you're watching this video, what are you waiting for? We go live every Tuesday and Wednesday when you live trade with me, and we get to analyze and capitalize on the markets together. And if this video definitely helped you, like, subscribe, comment if you want another video like this. And thank you guys for watching. I'm Hublo, and I'm out.